Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
All right, so this turned out a whole lot smaller than what I was expecting. I don't know. It's like an eye exam, E, X, whatever. So, but anyway, what I've tried to do is spell out just to kind of give you an idea of what the difference is. Why do this? All right, that's the question I get. Why would I want to do a deferred sales trust? Why wouldn't I just sell the asset for $5 million that I've got a $500,000 basis in? So my taxable gain is $4.5 million. So why wouldn't I just pay the 20% capital gains and the if you've got an LLC, if this is owned in an LLC, you've got to deal with the Department of Revenue and franchise excise, and you've also got to deal with the Medicare 3.8%. Why not just pay that, right? And I end up with 3,659. And move on. Okay, that's always an option. You don't have to do this, but if you do a deferred sales trust, okay, the top numbers are the same. You've got a $5 million sales price. Your basis is 500. Taxable gain is $4.5 million. Okay, and this is assuming that this is just for ease of looking at it. No debt. You've got this paid off. So what you've got then, so your net proceeds then, without the deferred sales trust. And with you've got your full $5 million in this trust to spend. Okay. Now let's say that your rate of return or your interest, you want to target a 9% rate that you want to try to earn out of this thing. Okay. So, or even if you do it directly, and this is for comparison purposes, so making the same 9% on your own or with your advisors outside of the trust. So your annual interest payments on the 9%. Outside would be 329, and in the trust would be 444. Okay, and then of course you're going to pay both ways. The income that's coming out of this, even though your gain is deferred inside this trust, and until you take it out, you don't pay tax. You still pay tax on the income. I wish I had some way around that, but I have no way around that. So after taxes, your annual interest outside on your own is 223, and inside the trust is 302. And if we do a 20-year look at this, then you end up with $4,478,000 outside and $6,043,000 inside the trust. Now, if you add to those payments how much your cash was out of the sale, then essentially the total payments you would have received doing it on your own outside the trust are about $8.1 million, but your total payments inside the trust are $11 million. Okay. Now you say, all right, now this ends and I'm not going to renew it. I'm ready to, be done with this. Let's go ahead and close it out. Give me my $5 million, right? And all the income I've received over the 20 years. So you're going to pay those taxes. You're going to pay them now, or you're going to pay them later, right? And this is assuming that the tax rate's the same 20 years from now as it is now. No way to know. So what I end up with then after paying the taxes outside the trust, net proceeds 8.1, inside the deferred sales trust 9.7. In other words, I've got 1.56 million more after 20 years with the deferred sales trust than I would have had if I just sold the thing, paid the taxes, and invested on my own, which is about a 19% difference. Now, if your investments want to generate a different rate, higher or lower, of course, all the numbers change, but this is a pretty typical scenario as far as these amounts go. So in this scenario, the difference is, about $1.5 million or more that you would end up with at the end of the day. And a shortcut to doing that is essentially saying, okay, if I'm going to pay the IRS $1.5 million for taxes, how much over 20 years could I use that $1.5 million to make? That's really the basic question, right? Because the rest of the money that would be yours anyway, you're investing it inside the trust or outside. All of that's pretty much the same, other than you're in the trust, you deferred the game. Outside, you've already paid it. But that IRS money that you're playing with and you're investing, that's really the key. And another way to look at that is you could generate about $1.5 million more over that 20 years using the IRS's money. Is kind of the simplest way to look at it. Garrett.
All right. So
He's going to bust all this up and tell me I'm wrong.
No. So if you're a business owner or your business is selling the property, it is the trustee then, or the beneficiary of the deferred sales trust, not yourself. Correct. The business itself is. So when those proceeds are given to the trust, the business has the rights to the proceeds if the business itself is selling the initial property.
Okay, so the question is, if the business is selling property, is the business the beneficiary of the trust? The answer is no, and here's why. Because remember, the trust is not set up to really have anything or own anything. So it would be the beneficiary of nothing. It would be the beneficiary of a trust that has $5 million, that owes $5 million, okay? So all the value is in the note. So the business is the note holder. It's the creditor. It's owed the $5 million. It's entitled to the stream of income. If it wanted to trade places with me, I would let it be the beneficiary and I'd be the note holder and keep all the money, right? So there's no value in the trust itself. It's the vehicle that allows it to go forward.
Yeah, and that's kind of what I was, I didn't elaborate well enough, or I didn't say the question well enough. But if the business is then receiving the income from the trust, and the business itself is, doing its own business, right? Property investment and management or whatever that is, then that would be additional income that, the business in intakes, and with the expenses of the business being what they are, you may or may not end up paying the same amount of taxes that you would if you were the individual receiver of that money instead of the business too. So
yeah, so the question is, if
if
the business is the note holder, the one that sold the asset, okay, is what we're talking about, but it also continued to do business and it has expenses and it has income. And in addition to that, it has the stream of income from the trust coming in. Can that be offset with normal business operations? The answer is yes. I mean, that income is just that. It's income. It doesn't suspend your normal operation where you've got expenses, you've got depreciation, you've got all those things that you can shelter this income. So this tax number here is assuming you've got no other income and no other expenses, right? So that is absolutely the case. And part of the planning a lot of times on these is to make sure that's the case. So the stream of income you're getting, you can shelter as much of it as you can to not have to pay as much tax on it as you're getting. So 100% yes. Yep. Pat.
So what happens to the trust when you die, and what cost basis do your heirs inherit?
Okay, so the question is, what happens to the trust when you die, and what cost basis do they inherit? So remember, you don't own anything of the trust. You're a creditor, so you own the note, and you can do whatever you want to with the note, right? You can give it to your kids. You can put it in a trust itself. You can do. It's an asset that you own, and you're entitled to that stream of income, and you're entitled to the $5 million being paid back to you when you're ready to pay tax on it. So nothing happens to the trust when you die. The question is, what have you decided you want to happen to the note that's entitled to this money, and where does that go, right? That's the question. And we can do some planning around that on the front end. We can do some fairly sophisticated planning and even have trusts involved, other trusts that own the note. We can have life insurance. We can have, there's some pretty crazy stuff that we can do around that. That is.
You can adopt me.
No, so it's, you can do about anything. Like I said, you're the note holder. Nothing changes that until you're paid back your money. That you're owed that, and that note can go wherever you want it to go. You can You can gift it, you can give it to kids, you can leave it in your state, wherever you want it to go.
Tommy, did you have a question?
Sure.
Real quick.
Yeah, can you talk a little bit about taking distributions from the deferred sales trust? So let's say you earn $5 million, and you say, I want to get paid $4,000 a month.
Okay, so the question is, distributions, as you've earned money in the trust, taking distributions. The answer is you're taking distributions all along, okay? So you have the note, the money's being used to generate income from that. You're getting that all along. That's not just sitting there waiting. That's being paid out to you as you go, right? So as you're using that money to generate income, that's paid to you in whatever interval you want. It doesn't sit and until you say, hey, I need some money. We do it on the front end. We say, okay, here's how much I want to live on or to play with or whatever. Here's how kind of return I'm going to need to get to generate that much money. And then we do the investments based on what your expected return, what you want it to be. So no, there's not any suspense account that the income comes into and then you wait. That's being paid out to you regularly as you go. And again, the whole idea is the trust itself doesn't have any value. You're being paid out the income. The trust has $5 million of your gain. It owes you $5 million. And so the trust has there's no value at any given point in the trust. Yep.
Can you pile gains from multiple properties into a single trust?
So the question is, can you pile multiple gains or from several properties in a single trust? Yes. I'm working on one right now and it takes some planning. It's not something we do overnight, but there's 45 properties I'm working on in North Carolina that they want to do into. And the hardest part is timing those. Now, if they're all closing at the same time, then that's easy. But they're closing in batches of 5 or 6, and the further apart those are, the harder it is to corral it all. But it's doable. We've had worse. We can do it. Okay.
Can you use the trust to go buy, again, if I'm a land guy, buy land and then go get a loan on top of that?
So the question is, can you use the trust to go buy some land and get a loan on that? And the answer is yes. And the way you do that is if you're going to make investments outside of, say, what you're doing with Garrett, right? Your traditional stuff, you're going to go buy land, you're going to buy a business, you're going to buy other real estate. Then what you do is you have me as a trustee set up another LLC for this vehicle, whatever that is you want to do, with you as one of the owners and the trust as the other owner, because the trust is going to put in the money that's needed to do this, but that LLC can absolutely borrow some money to do that. Yep. And that happens a lot. That's a lot of times what people want to do, because just because they might not do a 1031, that's usually situational. And it's not like, oh, I never want to buy real estate again. It's just, I don't want to right now, or I can't right now, or whatever. But when the timing is right, that's when they want to be able to do that.
Peter.
In addition to Pat's question about like how is like gonna set up the note for like his children, would like the will specify what that note, like how much each person is gonna get with that?
And so the question is, like in your estate, since you own the note, how you pass it maybe to your kids, it's just like anything else. It's an asset that you have. You can leave it to whoever you want to, and whatever percentages you want to, right? You can leave it to all your kids equally, or you can, it doesn't matter. It's up to you. You can, just like you're going to leave them of anything, right?
Or nothing.
Piece of real estate or nothing, right? Give it all to charity or whatever you choose to do. But no, you can, that's 100% up to you. That's a personal decision, and it's your asset. You can leave it any way you want to.
You can use your will like to say what's gonna happen to that, right?
Yes, you can do with that note whatever you want. There's no restrictions on what you do with that.
This made me think of another question. That's while I was waiting, but I was thinking about like the I guess the orbit of the money. So when it's coming from the trust, into the note, because the note says you owe me this money, does it go just to the note, or can you say, hey, it's going to go to the note obviously anyway, but then also go into whatever asset you want? That may just be repeating like whatever you just said.
Yeah, so the question is, the income that comes out of the trust, can you direct, kind of where that goes? The answer is no, that you're the note holder. This income off the note is coming to you as a note holder, okay? What you do with that is 100%
Right,
up to you.
okay.
You're paying tax on it anyway,
Okay.
so it wouldn't help you any to say, well, instead of giving it to me, do this with it.
Gotcha.
All right, it's kind of like if any of you own an LLC, you know that the income that generates, you're paying the tax on it, even if the business didn't have the cash to give you, right? Same concept.
Right.
So you might as well just get the cash and then do what you want to do with it, because deflecting it or rerouting it
Right.
doesn't help you. You're still paying the tax.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.